Let's bring in Ryan Lemand. He's the Senior Executive Officer at ADSI Investment Solutions. Welcome back to the program, Ryan. We digest this barrage of developments in and outside of China. We listen to some of the G20 commentary, and it's hard not to start believing that the market's underestimating the impact of the coronavirus on not just Chinese, but global economic activity.
Good morning, Yusuf. Great to be back again. Absolutely. And I have to say, we did underestimate the impact of the coronavirus. We did not expect that it will last so long and will take so long to peak. Now, from a medical perspective, it's not a concern. However, it seems quite handicapping to the economy. So just to give you an example, our office in Hong Kong, people are working from home. Now, for financial services, that's fine. However, for manufacturing, it does not work. Our concern is manufacturing. China today needs manufacturing. It needs to expand its manufacturing capabilities to fight the sort of slowdown it's facing. And this is not helpful at all. It doesn't seem that coronavirus will be peaking sometime soon. Chinese seem to be controlling it for now. However, it's still a serious concern on the global economy.
So this situation where you start buying outright defensive positions in assets like gold or maybe some other havens, and we've put this up on a chart, GTV Go, for our clients because one of your key calls has been Bitcoin. And I am a little bit surprised by that because we've seen an enormous rally already year to date. Which of the two would you prefer to have at this point, gold or Bitcoin?
Both. We don't have to select. These are diversification tools that we can use to diversify our portfolio, remain invested. Today, interest rates are very low, so holding on to cash can be costly. It's useless, actually, when there are assets that we can diversify into and invest into. And it's not only Bitcoin and gold. There are defensive stocks. There are some stock picking calls that we can have that actually make money. High dividend paying stocks are also an option.
Ryan, I'm looking here at some of the quotes that came out of the G20, and we had the French Finance Minister Bruno Le Maire speaking, and he says, do we want to still depend at the level of 90 or 95% on the supply chain of China for the automobile industry, for the drug industry, for the aeronautical industry, or do we draw the consequences of that situation and build new factories, new production, and be more independent and sovereign? That's not protectionism. It basically comes down to being sovereign and independent from an industrial point of view. Are we at an inflection point, perhaps, that the market hasn't even considered yet?
Absolutely. That's a very, very good point. Thank you, Yusuf. So basically, if you look at world manufacturing, almost half of it comes from Asia, mainly from China. So yes, the world really depends a lot on China for manufacturing. Now, if we take a step back, what's happening around the world with the new people getting elected, it's reverse globalization that is happening. And it's even way before coronavirus. And it's sort of accelerated with President Trump and straight talks with China. It's really a reverse globalization. Now, coronavirus sort of created this inflection point. It's a wake-up call for people that, yes, we depend pretty much on China. If there's a problem with China, then our supply chain is affected. So many countries are starting to consider diversification. What alternatives do they have rather than placing all of their eggs in one basket with China, basically? So yes, absolutely.
Ryan, hold that thought. We still have a lot to talk about. Ryan Lemand stays with us. I want to get back to my conversation with Ryan Lemand. He's the Senior Executive Officer at ADSI Investment Solutions. Ryan, you heard some of the commentary there, and add to that the preliminary PMI we got from IHS Markit just a couple of days ago, and the story it tells really scared off quite a few investors, dropping down to 49.4 from 53.4 in January. Run me through whether the central bank narrative around potential cuts can really address a problem that is centered around a coronavirus.
Well, it has been, we've talked about it, you and I previously, Yusuf. It's a concern, central banks today. Their back is to the wall. Monetary policy is a painkiller. It is not a treatment. However, it has been used as some sort of a treatment to try to reverse slowdown. So the result has been huge asset inflation in the US. All assets have gone up. 2019 has been a record year. However, this doesn't work. Negative interest rates, we've seen it. It hasn't reversed economic slowdown, hasn't created growth. There needs to be other actions, and this is our concern. When there's a stress test to the system, as Mr. Flint has mentioned it, so what do? Monetary policy is not enough. In China, it does work, and it is the right approach. The PBOC has flushed the system with cash. This is what you do when you have a big stress, because people try to run for the door, and liquidity is very important. This is how the PBOC acted, but it's temporary. You need other longer measures, more fiscal, more policy-related, more sector-targeted, to reverse this economic slowdown.
So you look at U.S. 10-year yields, Ryan, we're down back below 1.5% for the first time since August of last year. Also quite a bit of activity on the latter part of the curve. Is the market expecting too much here from the Fed on this?
Absolutely. Now the market is starting to expect a rate cut. It is expecting more easing. Until the coronavirus, the yield curve has been acting not based on inflation, not based on macroeconomics or economics in general. It's only based on what is the Fed expectation. And this is not very healthy. So today, this is what the yield curve is doing. It's looking at the Fed full stop. It's not looking at anything else. Now, yes, there is a flight to safety on the long term. It's quite traditional. There is a sort of a barbell portfolio at the moment between Treasury and tech. So as soon as risk subsides a little bit, we'll see Treasury widening back again and stocks going up and vice versa. But this is unsustainable, and we do think that policy has to intervene to reverse this status quo that is taking place.
So, Ryan, what do you do then with excess capital at the moment? Do you keep it on the side, or how does it get allocated in between stocks and bonds? Because the two are telling very different stories.
Absolutely. So it's basically stock picking on stocks. It's very hard work because rather than giving or adopting an allocation strategy across the portfolio, we really have to be very selective with regards to stocks. We would look for dividend-paying stocks. We would look pretty much on timing. So we are very closely monitoring the portfolio on a day-to-day basis. Now, fixed income today might not be the right option given to what's happening. It's also looking at alternative asset classes like the ones we mentioned: gold, Bitcoin, silver, and other asset classes.
Ryan, it's been great catching up as always. Ryan Lemand, he's the Senior Executive Officer at ADSI Investment Solutions.